Welcome everyone to a new episode of The Analyst. Today we'll talk about bank valuation. We're going to use one of the models that we've learned in our Fundamental Academy, which is using price to book value model, justified price to book, or what we call the ROE model. We'll try to value two US banks today, Bank of America and JP Morgan. We are going to use different fundamental numbers that we discussed in our Fundamental Academy video before. We have three things that you actually need. You need the G, the growth rate, you need the return on equity, and you need the cost of equity. As I mentioned, we're going to actually do this for Bank of America and JP Morgan. So let's first collect the data for Bank of America. You can visit the publicly available sites, and one of these sites, very important sites, is the Yahoo Finance website. You can just look at the bank, look up the bank, which is Bank of America. The ticker is BAC. Then you need to look for ROE. You can look all the way down through the fundamentals, and you can come up to this ROE, and the ROE in this bank is about 6.27%. For this bank, you can have a growth rate depending on your view of the bank, but given the bank's a bit underperformance, we can think of its growth rate as a bit low, as let's say 1.5. What's the cost of equity? This is the third thing we need, which is the cost of equity. Here we have it at 7.9. How do you calculate it? It's basically using the CAB model. Risk-free rate is 2.2%, the beta is 1.14, and the market risk premium is 5%. So how did you come up with the beta? Again, you go back to Yahoo Finance, okay, under the statistics, and you look at the beta. The beta here, it's 1.14. This is a bit riskier than the market. You just fill in the formula, then you can actually calculate the cost of equity. So how can you calculate the justified price to book model? How much is it? It's ROE minus G divided by cost of equity minus G, and here it is 0.75. Okay, so you need to multiply this by the book value per share. Where can you get the book value per share? You can again go back to Yahoo Finance, look at the book value per share. Here it's 24.19, and this is the MRQ. This is the most recent quarter, the latest financials published. So it's 24.19. This is the book value per share. But now, given that the ROE is less than the cost of equity and it's still growing, you're not going to pay the book value. You're going to even pay less than the book value. So actually, your valuation here, it's 0.75 times 24.19. It's 18.03. What's the market price? It's 20.86 now, and you get it from the market again, 20.86. So you think here, based on this model, that the bank is a bit overvalued in the market because there's a downside potential of 14%. So you should actually be selling the stock, or if you don't own it, you can actually short sell it in the market if the market allows it. So the book value is 24, but the market price is 20, is less than book value. It's not, you cannot just jump to conclusion and say, okay, the stock is undervalued, it's trading below book value. No, you have to look at ROE compared to cost of equity to make sure that the bank is generating enough return to make up for the required return that you require. Let's look at JP Morgan. Let's do the same thing for JP Morgan. Look up the stock, it's GPM. There's the market price, 78.83. You need to get the beta, it's 1.11. It's less risky than Bank of America. Again, you apply it. The cost of equity then is less than the Bank of America because the beta is a bit lower. It's 1.11 versus 1.14, and that's why the cost of equity is 7.75, less than Bank of America 7.9. Now, what do we miss? We're still missing the book value per share, okay, and ROE. Let's look at the book value per share. Here it is, 63.8. Again, this is the most recent quarter. And for the ROE, again, you look up the ROE. Here it is 9.38. Be careful, it's TTM. This is trailing 12 months. Trailing 12 months. These are the last 12 months reported by the bank. So looking at the last 4 quarters. So it's 9.38. This is the ROE. What is the growth rate? This is the largest bank in America, so you can actually assume a bit higher growth rate than Bank of America. So let's say it's 2%. So you have a growth rate of 2%, ROE of 9.38, and you have a cost of equity 7.75. Just apply the model, ROE minus G divided by cost of equity minus G. You come up with a justified price to book of 1.28 times. Okay, 1.28 times. So you think, based on this model, that the stock should actually trade at 28% higher than its book value. And as we got the book value before, it's 63.8. So you multiply this by 1.28, you come up with the fair value, which is 81.89. Given the market price of 78.83, this is a 4% upside potential. So maybe you should actually buy the stock because it's giving you a 4% upside potential. If you don't think it's large enough as a 4%, you can look up some other stocks that can actually give you a higher rate of return. Okay. Let's look at Bank of America again to see how other analysts in the market actually value these banks. If you look at the Analyst tab, you can look up the history here. Look at the price target. On the right hand side here, you see the Analyst price target. The average is 18.68 and the current price is 20. So our valuation was 18. It's very, very close actually to what the average analysts have actually valued Bank of America at. Let's do the same thing for JP Morgan. You can look at its average value. It's 76.24. Okay, it's a bit slightly less than the market price. Ours is a bit higher. So we have a bit higher valuation than the consensus. Let's say that the growth rate is the same as Bank of America. You can actually change the valuation depending on the different factors that you have. You can add, or that you can just play around with the numbers to make sure to try to make sense out of the numbers. It's up to you to have a specific story that you want to reflect in these numbers. Thank you very much. We'll talk next time about different valuation in real time. Thank you very much.